Gareth Soloway, President and CFO, Chief Market Strategist at InTheMoneyStocks.com, joins us to talk about the gold price action and touch on the 10-year Treasury. This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Gareth Soloway, welcome to Metal Money. How are you doing?
Hey, I'm doing so well. Thank you so much for having me today.
Thanks for coming back on. Appreciate the time once again that you've given. Gareth, when we last spoke, you showed how the $1,750 price point was a perfect 38.2% Fibonacci retracement level, and we're speaking of gold here. And reaching this level would mirror how gold moved back in 2008. The trading action in the past few days have brought gold to this level. How do you expect gold prices to move from here on out?
So I did a lot of gold buying in just the last few days, picking up not only the GLD, but also the GDX, which is the gold miners. And not only do I still think this 382 retrace level around 1750 on spot is a major level, but I also am noting on the GLD chart how this is a very important support level in the near term. And what I'll do is I'll quickly show my chart here, and this will give you a nice little idea of what I'm looking at. So here's the GLD chart, and you can see we've been consolidating. I mean, I know it seems like we're well off the highs, and we are, but if you look and zoom out on the chart, you can see that it's basically bullish consolidation inside of this bigger move to the upside. And if you look at the retrace on the GLD here, we've actually retraced to this consolidation sideways pattern. And if you look at the lows on the GLD the last 3 days, and you can see right here, the low pivot, you have lines each representing the low there. It's actually represented by the midpoint of this high pivot to low pivot consolidation range. So high pivot to low pivot, this is the midpoint right there. So to me, that signals not only a lot of consolidation, but continuing around that 382 Fibonacci retrace of the move. And again, like I said, I've been a buyer of the GDX in the last few days. I've been buying GLD. It's good to see GLD and gold starting to move up today. Initially, we saw some weakness, but now we're seeing buyers come back in.
So how about silver? Are you seeing similar patterns in silver?
Silver's a little bit of a trickier situation because you have this industrial component. You've had a lot of retail interest on silver because of the Reddit crowd and people talking about, can it go to 500 an ounce, 1,000 an ounce, or 100 an ounce? All of those moves would be astronomical. So you've seen this kind of weird play where you have this average investor demand, but you're not seeing it necessarily play out in the charts. We saw a very short-term pop on silver, and then it retraced very, very quickly, which is not good, right? I mean, if you look at the strength in a chart, when a chart breaks out like it did on silver off of the Reddit, Wall Street Bets crowd, it failed within a day. And that makes me a little bit more concerned short-term on silver. I still think silver is a no-brainer to hold as a long-term investment, but I wouldn't be surprised if you get a little weakness in on silver over the next couple weeks or so.
Gold prices are well below the 200-day moving average, while silver is still trading above that 200-day moving average. And silver prices have not seen lower lows since August of last year. What do you make of this difference between how both of these metals are moving right now?
Yeah, so to me it looks like gold is partially behaving like the retrace we saw, the 382 retrace in the previous big breakout in the kind of the 2009 to 2011 period, and then also you're seeing this Bitcoin divergence where you've seen a lot of money come out of gold and flow into Bitcoin, and to me it looks like people are going with the hot thing. I've always been an investor who I like things when no one else likes it. So with gold versus Bitcoin, I'm much a bigger fan of gold right now because it doesn't have that spotlight on it. It's kind of, that's where you want to accumulate these things. In regards to silver, silver's, again, it's such a tricky thing because of how it's behaving and the retail interest right now. And for me, I just have to step back until I can get a better chart read. It is still holding the 200 moving average, but the short-term chart remains slightly bearish.
For the longer term, are you still looking at $2,800 gold? And how strong is this case for $2,800 gold?
$2,800 gold is very strong. In fact, I think you could even see as high as $2,400 by year end, where if you look at currently where gold is, that would be a tremendous percentage gain by year end. But within about 2 years from now, I do think you hit 2,800 on gold. And again, the way I figured that out is if you look at the chart move going back to the last breakout, and then we had that simple 382 Fibonacci retrace, and then the subsequent move. If we're replaying that exact thing, then that should be our target on gold. And it was achieved within about 2 years back then. It should be about the same this time around. And again, what we call that is a measured move, where you see the same move kind of hit over and over again in a market, mainly because psychology is much the same. Investor psychology doesn't change. Greed and fear rule the market. So you get these replica moves over and over again.
Yeah, it seems like a measured move is silver consistently getting hammered down. But for the longer term, what would be the equivalent price of silver when we do reach that $2,800 gold?
Oh, that's a great question. That is a great question. I would say you probably look for a doubling of silver at least. So I mean, if you think about 2,800 on gold, that would be about a a little bit more than 50% move on gold from its current levels. My guess is because silver moves at least 2 times what gold does, you'd at least see silver double. So again, even though I'm bearish in the short term on silver, you have to be longer term bullish considering all the printing of money. The Fed just continues to be in this zone of not allowing the market to be a natural market. They want to continue to print money. They're so fearful of a big market drop that would tank the economy, especially as we're coming out of COVID here, that they're just going to keep printing money. And, we know that the stimulus $1.9 trillion plan is probably going to go through. Then you're going to have another trillion in infrastructure. And then if the economy hits any sort of bumps, it's more printing, at that point. So, definitely diversify away from dollars and protect yourself.
Yeah, I think another market that may not be natural anymore is the bond markets. What's the main takeaway for investors regarding the market talk? All this market talk about the rise in the 10-year treasury yields.
Yeah, it's really an amazing thing, we're as investors witnessing. I mean, historically, you don't see moves like this in the bond market almost ever. It's remarkable, but it shows the dislocation of what's going on. So you have this economy that's, we're already seeing it starting to roar, and it's only going to roar more and more. And people have more and more money in their pockets, at least most people. Listen, there are a lot of people hurting where the stimulus does need to get to, but there's been a lot of people that have been working from home making the same amount or more. They haven't had the costs of driving, the car costs, the insurance costs, and they're swimming in money because they haven't been able to travel. So inflation is out there. That's going to create further upward pressure on bond yields. We have seen a pullback here in yields off the 1.5, 1.6 range. Like we were talking about prior to the interview, you said that the Fed was out there, pushing yields down by buying bonds. They did not like that surge in yields. Crazy that they're out there, but they're trying to protect the market from a major collapse. But my expectation is this: you will see bond yields come back in a little bit more. I have a low pivot of around 1.3% on the 10-year, and then yields will start to push up again back to 1.5%, maybe 1.6. The Fed will do their best to kind of not let them push through, but my guess is eventually the Fed will have to give in and let yields push up. And this is what's going on here. So the Fed has to pick their battles, right? The Fed is a big entity, but versus the rest of the world, they can't compete. So if the rest of the world's kind of, like, all right, well, we'll take profits on the gains on the yields here and the yields go back down, the Fed is pushing them down as well. That helps. But when you get everyone else pushing against the Fed is going to have to say, okay, at 1.5%, I have to let them go up. And they'll pick another point. My guess is at 2% to cap them again and try to push them down. And the Fed's goal here isn't really to keep yields at all-time lows or at 1.5% or below. The yield for the Federal Reserve, it's about raising it very slowly. When you do anything slowly, like if we see oil prices inching up a few pennies a day, no one really gets worried about it, right? It's when they jump dollar after dollar after dollar where the consumer starts saying, oh my goodness, last week I paid this for gasoline, this week it's this. That's what the Fed is really monitoring. So I do think eventually we push above 1.5%, and the Fed will then pick its next kind of, Alamo or line in the sand where they have to defend it.
Okay, so let's say we get to that 1.5% or maybe even 2%. Would we be looking at equities markets down, gold up, inflation up?
Yeah, so that's a great question, especially when it comes to gold, because we've seen recent weakness because yields were going up a little bit, which is the growth side of things. So people have to make that decision: do I want to hold gold, or if I, can get into a bond yield that's 1.5%, is that worth it versus gold for the safety of the yield in the bond market? That's the initial stage of it. Once you get to the inflation and the fear of inflation, that's where gold is really going to rip higher, and that's where, in my opinion, I mean, you could see gold kind of hovering around 2,000 an ounce or just below for the next 3 to 6 months, and then in the final 3 months of the year or into 2022, gold could rip up literally $500 in a very short amount of time when that inflation scare comes. And it's going to come, folks. I mean, there's no way we've printed more money in history than we ever have before. This is an uncharted territory type thing. You can't assume that you're not going to see inflation, and not a lot of inflation. I mean, you had interest rates in the U.S. in the 15% range in 1980, and then look at the amount of money that we're printing right now in comparison. It's not even close. So again, you have to think that inflation will come at some point. That'll be very bullish for gold and silver and other commodities. But I also think it will hurt technology, and I continue to be someone who's underweight technology, on the short side of technology in many cases, versus being long gold and long other commodities.
All right, Gareth Soloway from InTheMoneyStocks.com. We appreciate the time you've given us, and we are definitely going to have a lot more to talk about in the very near future.
Hey, thank you so much for having me so much.
There you go. What to understand and look for short term for gold, silver, and the 10-year. As always, let us know what you think in the comment section below, and remember to keep it liquid, keep it real, and I'll see you on the next episode of Metal Money.